there's certainly a lot to talk about. This is the beginning of the second quarter. Obviously, the first quarter was one that came in strong. We were at an all-time high early in January and drifted downward, but it did have a nice recovery to end the third quarter, Derek.
Yeah, we certainly did. I mean, we talked a lot about sentiment being a little bit too negative. We talked about a very depressed fear and greed index reading. So sentiment was decidedly on the negative side, and naturally so. We had a lot of negative headlines out there. We had the invasion of Ukraine. We had higher inflation readings. We heard that the Fed dot plots had gone from 3 hikes in 2022 to as many as 7. So there was a lot of negativity priced in, and that's what we keep trying to stress to all of our clients, that the stock market discounts forward news, not with a rearview mirror, and that's always important to keep in mind.
Yeah, that's for sure. And we did get some clarification on a number of those issues, particularly the Fed. The Fed, obviously raised a quarter point, and now it certainly looks like they're going to do a 50 basis point hike in the next meeting. So, there's getting clarity. And this climbing up a wall of worry always comes and goes when we get more information. And we did get some information on this past Friday afternoon when we got a jobs report. And at the end of the day, in my opinion, it was a really good report.
It was. It was lower than expectations on the headline number, but when you add in past revisions, it turned out to be right in line with estimates. But we showed the unemployment rate going down to 3.6%, which is 1/10 away from the lowest reading we've had in the last 50 years. So the jobs market certainly remains strong. Wages are rising up 5.6% over the past year. And while that's too slow to keep up with the current rate of inflation, it does suggest consumers are in a fairly good spot.
Yeah, so they're coming back to work 3.6%. I mean, that is a really good number. Back in the economic class days a million years ago, Derek, we used to say full employment was less than 5%. So we're there right now, and the Fed, of course, has got to worry about the next boogeyman, which is inflation. But a labor force that has people coming back in substantially is really good. There's folks that are coming back into the workforce, which is driving up wages, which, of course, goes into the inflation argument.
Right. And the other key point on the inflation argument is owner equivalent rent. We know that housing prices have been very strong over the last couple of years, and in particularly the last 12 months, and that tends to leak into higher rental costs down the road. So we do expect inflation to be higher than what we've grown accustomed to over the last 3-4 years, but we do not expect these current readings of 8-9% to last much longer.
And that is a really good point. We did say, if you remember, that last year is when we get past key supply chain issues, that inflation might start to come down a little bit. We are in that camp by the end of the year. You might start to get some mitigation in inflation, but the Fed is in a really tight spot. They're going to raise, as we now know, several times coming up. But if they raise rates too quick, the bond market is going to suggest that they're making a policy mistake. And that comes in the form of an inverted yield curve.
Right, and that's typically a sign that the market believes that the Fed is making a mistake in the sense that they're tightening too quickly, as you mentioned. And we're obviously going to have to monitor that because a lot of this is going to be a data-dependent issue. Powell has said over and over again that the pace of the rate hikes will be data-dependent, and he doesn't want to tank the economy and push us into a recession. So even though some yield curves are starting to invert, there has never been, obviously, a recession without an inverted yield curve, but there have been several times where the yield curve has inverted, and we have avoided a recession.
And just so folks know what we're looking for, that doesn't mean that the recession starts tomorrow. It does suggest that in between 12 and 24 months from now, we're going to get a slowing economy, and we're going to have to watch that very carefully because it will have an effect on your bottom line.